So, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. I'm Merrill Chandler, and welcome to the Are You Effable podcast. Welcome back, everybody. Merrill Chandler, your host of Are You Effable. Now, in this episode, I was going through some archives of our Facebook Live presentations where Brad and I are doing more questions and answers, right? We are taking questions from our insider group, from our Facebook Live participants right there, live and in color. And some of the things I haven't covered, some of the answers to these questions, the questions themselves, I haven't even covered in podcasts. So I thought, it would be perfect for you to be able to hear this live and in color. I think even one of them, for those of you who are watching, I believe even one of them, I'm up on a whiteboard kind of outlining strategies, etc. So I believe you're going to enjoy it. It's worth it to me to give it to you. So I hope it's worth it to you to make sure that you add this to your knowledge base as we continue to make you effable. So when we get back from the introduction, we're going to drop right into the question and answer in this Facebook Live. I will see you on the other side.
Ta-da! Hey, have you noticed we're now not taking ourselves so seriously?
I'm still taking myself very seriously.
Brad tends to. Want to report great things are happening in credit sense land, and we've had some wonderful feedback about some of last week's topics, which we want to kind of readdress because, guys, especially when it comes to profile optimization, funding optimization, I'm a line drawer, right? Drawing lines in the sand. And because I'm trying to protect our clients, I'm trying to protect those of you who are listening to us, the 80 percentile, the bell-shaped curve, right? 10% radical this way, 10% radical this way. But what applies to 80% of us applies to 80% of us. Now, I want to make sure that you guys are doing safe things if you're taking any of our suggestions to heart and beginning to implement them. There came to us this week a couple of outbounders, right? Out there in the 10 percentile. Outliers that we needed to, we felt it was important to address. So I was thinking of the authorized user one and kind of...
I was thinking that one last.
Okay.
Yeah. Because the first one I wanted to check out was we got a question in from Mackenzie in Washington. Okay. And her question was really straightforward. What is Experian?
That's like asking, what's a credit bureau? All right. And actually, this is a great opportunity to address it. So, kind of 1,000-foot view. There are what are called consumer reporting agencies. All right, and it's known as CRAs. A consumer reporting agency falls under the Fair Credit Reporting Act. And in 1971, which we'll get to in a second, in 1971, Congress said, whoa, there's so much blacklisting going on, and people of color and races and even communities inside of the same cities were discriminating against each other with all these things. So they came up with a Fair Credit Reporting Act that didn't allow you to be blacklisted. More on that later. But what all distilled out of this is Experian is one of the final three in the merging process over the last century of these individuals, companies, and organizations who began reporting on originally all kinds of stuff, but is now limited to payment history. And a credit reporting agency has to follow the rules of the FCRA. Now, in our organization, we call them credit bureaus, because we want to specifically remind our clients that we're talking about Experian, TransUnion, and Equifax. Okay, those are what I call the unholy trinity of credit reporting. And if there's a big brother out there, guys, it's less the NSA than it is credit reporting, because did you realize that when you swipe your card to make a purchase, debit or credit, that barcode, that magnetic code that goes in there actually tracks the type of purchases that are being made by you. Have you ever wondered why? You buy a watch and then in the mail or in your email, 4 or 5, 10 days later, you get this perfect catalog of all these watches and stuff. You're like, how did they know? Your magnetic strip carries far more than your account and debiting information, and those SKU codes, the SKU codes that every product has now, when they scan it, they are linking those to your purchasing behaviors. So credit reporting is extremely invasive. How many of you walked into a mall lately where there's a kiosk standing there and they read your Google phone? Google is infamous for this. And Google phones they're actually popping up saying, hey, did there's a 10% discount here at the Buckle. And you're like, I don't shop at the Buckle, but I just walked by the Buckle, and Buckle have these little codes and infrared transponders out there that are hitting, especially Google phones, but you can have the app inside of your iPhones, and you're now being tracked, these micro-tracking, so that they can make you aware of specials as you walk by a store. Straight out of the Minority Report. Remember the movie The Minority Report? You walk by and says, well, hello, Merrill Chandler. Did you know that you can go to the Caribbean for $400 less than everybody else?
Yeah.
Right? So credit reporting is designed to help merchants and lenders make money. And so Experian is one of those final 3.
Yeah, one of the final 3 credit bureaus. And a follow-up to that is really, I like the story, right?
I believe the story.
It seems pretty plausible. But where credit bureaus came from.
Okay.
Because we came to 1971,
yeah.
And now also we have the FCRA.
Yeah.
But where did they come from before that?
Okay. Guys, this is awesome. This is organic development of a machine at its finest. So, for 6,000 years, agrarian communities had somebody who was a merchant, like the general store you see in the Western movies and stuff like that, and the farmer would come in and say, hey, if you give me a sack of grain today, I'll give you 2 sacks of grain at the end of harvest. Right? That was credit. You were local to the community. You weren't going anywhere. You were tied to the land. And so people begin, oh yeah, can I throw some flour on there, some baking soda so I can make, my hot cakes? All of those things, the general store was kind of the center point. And now you could have a bar tab, and you could have, at the saloon, you could have tabs everywhere, but everybody counted on you being a member of that community, and credit was actually given that way. Now, interestingly enough, when you asked on credit for a bag of seed and you paid it 2 bags back, that's 100% interest, right? If we want to put it in today's financial terms. Well, for 6,000 years, that's basically how credit was extended and how it was paid back. As in the Industrial Revolution, as it began to move from agrarian society into the industrial society, people were the next generation of children were all moving to the cities looking for work, and everybody were still in boroughs. So New York is still the biggest, hugest reminder of that. There's 7 boroughs inside of New York City. But the fascinating thing was that all communities were broken up, usually by ethnicity, by different dialects and or countries of origin. And so you knew your own people, but to go to somebody else, you're a little more of a foreigner, even if it was just 4 blocks over. So what began to develop were in the 20s, the 30s, all the way into the 50s, were what were called merchant associations. Originally the butcher kept a tab, in that agrarian society, the butcher kept a tab, the general storekeeper kept a tab, the tailor kept a tab, everybody kept a tab. But they didn't coordinate, hey, did you get paid back by Merrill Chandler? The butcher, did you get paid back by Merrill Chandler? Should I extend him? You know, he needs a Sunday go-to-meeting outfit. Do I extend it to him on credit? Did you get... Unless they were talking over at the bar, at the saloon, not a lot of communication was going on. And so a necessity is the mother of invention. So these merchant associations started coming together, and an individual said, hey, I'll keep tabs. Baker, give me the juice on Merrill Chandler. Butcher, give me the juice on Merrill Chandler. A barkeep, give me the juice on Merrill Chandler. And they started keeping ledgers of who had and who had not paid, whether you were, whether they could trust to lend to you or not trust to lend to you. Now, a quick aside, you know who the very first extension, formal extension, industrial extension of credit was? The very first one in 1910 was the Model T Ford. Ford had the idea that if you let somebody drive the thing while they paid for it, they would probably keep paying for it. And so the Model T Ford was the first extension of credit as a business model, as an industrial, like a central corporation. Singer sewing machines, you know, those old pump machines that you use.
Most people have no idea what you refer to.
I actually grew up. Sorry.
You can find them in museums.
Or at my mom's house. Because it was old school. It was a paddle sewing machine. And I grew up with one of those in my house. My mom used an electric one, but it was from her parents before her. So Singer also extended credit for them to be able to buy these sewing machines. So, end bracket. Well, when these merchant associations, they started expanding, and they started crossing international boundaries between boroughs and boroughs and boroughs, right? So, interestingly enough, Experian is a public company.
Yes.
TransUnion is a private company. And Equifax is a public company. TransUnion still is out of Chicago, Illinois. There are other things that happened in the 20s, 30s, and 40s that of a notorious ilk that also included keeping lists on people and seeing whether or not they paid their protection money and whether or not there was, you were doing what you're supposed to in the framework of being a business owner in Chicago. And while I've done some research, the deeper you go, there are certain things that Capone and some of the other ingenious businessmen of the day who used muscle in order to extort money out of businesses, because they kept records on every single business and the bad habits of those business owners, and could leverage over those business owners. Well, that's why, as it came to be later, these merchant associations grew and grew and grew in influence, and they became so non-selective about what they meant, because Capone and his crew, they were keeping all the data on you. So at some point, the Fair Credit Reporting Act said it can only be about your financial relationships and how well you pay your bills, instead of keeping your race, creed, color, religion, ethnicity. All those things were actually counted by these credit bureaus, or by these original merchant associations. So we're in a position now where we have the unholy trinity that derived from all of this record keeping, and the Fair Credit Reporting Act has been amended twice now in order to tighten up how and what it reports. So, long answer to a short question, but Experian is one of the three credit bureaus, and the source of these credit bureaus derived from the modernization of record keeping to see whether or not you are worth lending to. And now they keep every single business as a subscriber, so they can rat you out as well.
Yeah. Now I'm gonna go out on a limb here. So
yeah, I hate being out there.
if any of that caught your interest, because the story goes deeper, it goes far further into history, into the past, and Merrill has an incredible ebook that he created, what is it, 8 years ago?
Yeah.
That it goes into the money system, it goes in, and then we have another one that goes into the credit system as well. So the insider secrets. But if any of you have interest in that, and when you see this video, shoot us an email at info@creditsense.com.
Yeah,
and I'll be happy to get you guys out a copy of the
That's a great idea. Full color. I mean, it's beautifully illustrated, and you're right. It goes way, way deep.
Way back.
Both into the money system, insider secrets to the money game, and insider secrets to the credit game. So you'll kind of get an idea of what it's about. So yeah, ask for it, guys, and we'll send it to you.
Yeah, you can even learn about the concept of the king's ransom if you want, and more in depth than you may have ever in your life. So
yeah, you'll be like, I just went to history class.
Yeah.
By the way, I did graduate in history, so I love the source of everything, right? I love knowing where the roots are.
Yep. Now, to bring that back to credit bureaus today, you capped it a little bit, but keep in mind, guys, these agencies are literally tracking every single thing that takes place. That's how you're in a position where the FICO system now comes into play, because FICO is not part of the credit bureaus or part of the reporting system. FICO is the risk analytics. So
of all that data.
So they tell the lenders how much of a risk you are if they lend you money. So you think about how this looks, and we'll go into more of this later, but you've got the banks, and they are the customer of FICO, right? You got the bureaus, and they interact with FICO, and then you've got you. And Merrill's talked about this at length.
Yeah,
right.
Just quick. So you have you, right? And then you have the banks, bureaus, and FICO, right? And these guys have a relationship. These guys have a relationship, and these guys have a relationship. The only one left out in the cold is you, me, us. And kind of where we fit, CreditSense, is that connective tissue to help everybody understand, okay, because credit reporting is not credit scoring, guys. They're not one and the same, just like Brad's saying. FICO is in charge of scoring, but the banks and bureaus, that's credit reporting, right? And when we say banks, remember, the limited clothing store uses a bank to carry its paper. So it's still a bank, it's just one of our junk cards because it is a financed merchant. So everything, the banks and bureaus are just been in it, they've been at this for 90 years.
Yeah, a long time. So if you're brand new to this, make sure you figure out how to play this game. Figure out how you fit in that mix so that you can really seamlessly navigate this, what can be confusing process. It can only be a mess.
Modern day banks, and when I say modern day banks, they've been playing by that playbook, the same lending playbook, for 500 years. We said this in our presentations when we're out our real estate, our note buying conferences, but bureaus have been doing it for 90 years, and FICO's been doing it for 70 years. I mean, if you don't know what you're doing, the odds are stacked against you because they are all playing by a playbook that you have no clue what the rules are, right?
Yeah, and they're $1 billion industry.
Yeah, every single one of them.
Yeah, so the billions and billions backing them. So yeah, the odds are stacked against you. So great explanation. I like it.
And great graphics. If you know me, you know that that's actually really, really clean and clear.
He was trying really hard to write it. So it was legible.
I was trying really
So, all right, next question. Moving on. Let's see. Let's go with the authorized user strategy for newbies, because we've talked about authorized users, right? The last couple times we've said how they can impact your score or impact your profile.
Right.
How the negative is more substantial than the positive contribution.
Right.
But we got a bunch of emails and
blowback.
Yeah. Because
some of the blowback came from clients who said, "But you told me to do this," and so we'll explain it.
Yeah. And so Scott, actually out of Ohio, says, "Please tell me about the authorized user strategy for newbies."
Yes. Okay.
And that strategy is the strategy where there is a practical application, very narrow positive value of having an authorized user. And take it away.
All right. So I did get kind of castigated by a couple of clients, and I didn't even know it's about Scott. I just got it from one of our credit advisors saying, "Hold it, Merrill, you just said on the thing that I didn't say under no circumstance. I just said it's bad juju." And one of our clients saw it because we post these in our client vaults and everything. And he saw it and he goes, "But hold it, it's on my optimization plan to become an authorized user." Okay. So there are 2, maybe 3 very narrowly defined times that we want to be authorized users. There are opportunities, what we call newbies, brand new credit, many of our real estate investors and clients have us start building a perfect profile for their children. Okay, so a brand new 18-year-old. All right. Now, by the way, a few years ago, a law was passed that because as they tend to, because lenders started flooding colleges with credit applications, and people were getting into students were getting into credit card debt, like to the tune of tens of thousands of dollars before they were 20 years old, because they had been trained on how to use credit. They didn't know how the game is played. And so Congress came back out and kiboshed that whole thing. Do you realize you have to have parental or a guardianship approval to acquire any kind of what we call cash cards? A cash card is not a merchant card. A cash card is like, it treats like cash. You know, you use it and you use it anywhere, and it's like paying with cash. Not to be confused with a debit cash card, but unless you have authorization, you have to be 21 years old to actually formally go get your own unsecured credit cards. So we have a strategy where at 18 years old, now you can get a secured credit card at 18, and we have strategies. We talked about secured, I believe, last week or the week before. So there are strategies in which we can start building credit profiles for young people. But more interestingly, we can actually use the authorized user under certain circumstances. Because remember, when you close that down, like we ultimately will, you have a closed, your oldest card on your profile is now closed. And so we have to evaluate what your long-term goals are and the pace with which you want to grow your profile. But brand new individuals can adopt or can become an authorized user on a parent or other adult credit card holder to establish a baseline score to get other credit instruments. If they're children, we've run into it as the children of real estate investors, where they want to be, the parents want to put the child on a mortgage, but they have to have a substantial score. They will accept an authorized user if there's other trade lines there. They will add to the age and the score criteria, because mortgages are really score sensitive. That is not as much profile sensitive, because for obvious reasons it's secured by a home. So once you have, so that's one instance. Young people, 18 to 21-year-olds who are beginning to build a profile, there may be an opportunity to pick up, but do not get addicted to the score that comes with that, because it's not based on anything that a bank or a lender is going to use to you. If you're going to get put on a car as a secondary or co-borrower, if you're going to be put onto a house as a secondary or co-borrower, this strategy, the authorized user strategy, may help. It cannot be your only trade lines, but it will help it benefit those other more extensive purchases. Another opportunity is post-bankruptcy. There are times, again, it depends on your end game, guys. You don't just go do it because it'll give you it'll jump your score up 20 or 30 points, okay? Because an authorized user is not going to get you approved for anything unless you have a plan to get the next tier and value contribution account so you can start building a profile. But you can do it post-bankruptcy. So, now, we've recommended, there have been a couple of clients who were post-divorce and their credit got thrashed, and we saw an opportunity to use an authorized user temporarily as a bridge towards getting their own secured accounts, or put on another vehicle or on another mortgage to start building out the file. But notice, we're using this authorized user to establish a beachhead on installment loans, guys. They don't really do much for us over on, unless it's secured. It doesn't do a lot for us over on the unsecured building of a revolving account portfolio. But it does help when you're establishing installment loans as a co-borrower or as having a co-signer on a car or something like that.
Yeah, and the idea to just put a bow on that is you want to use this strategy for a very short period of time. It's not something that, as Merrill said, don't become addicted to the score. Don't think you need to keep this on forever. A simple solution that, if you plan for it, would be to use the authorized user, get the approval that you're looking to get, and then in short order, and the timing, it would vary, right? I can't tell you exactly.
It's certainly not over a year.
Oh yeah.
It's certainly not over a year. It could be as little as 6 months.
Yeah.
This is just an interim bridge.
Yeah, it's an interim bridge. So the plan is I will remove this authorized user at some point. It's not to just keep it on my profile till the end of time. Especially those of you who have any aspirations of truly becoming a person who masters leveraging your profile, especially for business. Now, I know this doesn't go out to all of our specific clients for business and investment purposes and things like that, but if you have that idea in your head at all, that maybe someday I want to get into investments, having an authorized user at that time becomes almost a nail in a coffin.
It really is. It's bad news. You're not a sophisticated borrower, which is what he's talking about. Yeah. Leveraging other people's money to build real estate empires, or whether you play the stock markets or you're buying and selling commodities online. Leverage is renting your money for cheap and being able to make more money with the money that you have borrowed. That is a sophisticated borrower profile, and nowhere in there does an authorized user card thrive, prosper. It actually, as he said, it's a nail in the coffin.
Yeah. So there is a time, there is a place. It's a very narrow window.
Very rare.
With planned obsolescence.
Yeah.
Right.
Yeah.
Like right now, your iPhone.
Yes.
So I don't know if you guys experience this phenomenon. It has nothing to do with credit, but it has everything to do with my belief that there's a system playing against me.
Toasters and all kitchen appliances.
Planned obsolescence is the concept of every time a new iPhone comes out, I get an update and something starts going wrong with my iPhone that was working perfectly up until then. So we just got the iPhone 10s, now your iPhone won't hold a charge.
All of a sudden my battery keeps draining. I knew there was a problem when I called Apple, the local Apple store, and it says, if you're having problems with your battery, press 1. I'm like, oh.
Yeah. It's getting us.
Exactly.
But you need to do that with your authorized user. I think that was my point.
Planned obsolescence. It is a temporary, usually very quick the 6 month, never more than a year. It's to take a 5-year card, create an impression, usually for installment level co-borrowing. You're not going to go get a mortgage on your own with an authorized, 1 or 2 authorized user accounts, guys. It's not going to happen. It's to allow you to see that you are a part of this other person's life, especially if you're an authorized user on their card and they're now putting you on a card or a mortgage. Then it looks like it's a family affair, right? And they have allowances for that. To go out and randomly get business lines of credit, never going to happen.
Yeah, that's not going to happen. Could you get a Discover card? Yeah.
Well,
right.
If you like,
but it's a tier 2 80% card, right? Like, so I wouldn't necessarily recommend it. Could you maybe even get a Chase card? Yeah, but there are going to be other factors that come in when you submit your application. Could it help for that little thing? Yes, you're not going to get a $10,000 limit in most cases, but it can help with those. It can help you get started.
Right.
Get off the ground.
What was that client who put an authorized user on there and they shut down the client because of the authorized user, not even because of him? We
might have talked about that.
Yeah,
we did talk about it recently. I don't know if it was on a Facebook Live or on a client tech webinar.
Oh yeah.
But yeah, no, we talked about it where
it's worth it
because we were talking about balances. That's what
it
was. It was a Facebook Live because we were talking about balances and they ran their balance up real fast and then all of a sudden.
And it was the authorized user who ran up the balances.
Yeah.
They shut down the card and he's like, I have a great score. But the authorized user, when you look at his credit profile, was a trash score. Guys, they measure everything, including who you give a card to. Perfect example.
A new card.
And the authorized user can blow your profile up, or at least your chances at building a good relationship with a lender.
They can. Now, keeping in mind, in that particular instance, it was a brand new card and an authorized user who had a nuclear explosion in their credit profile.
He burned every possible.
He had charge-offs with that same bank. So that same bank had charged off thousands of dollars on the authorized user previous to being added to that account. So it wasn't long before that name popped up in the system. So it's not every case, but in a situation like that, an authorized user can actually hurt you.
We have seen everything, haven't we?
Pretty much.
We have seen everything.
Yeah, not much we've missed. All right, so if any other questions come up, we're not getting anything online right now, so shoot them into us. Again, info@creditsense.com. We're happy to answer questions if you have them post-video live. And then the last question is buying a new car. So Jackie in Florida says, is there anything I have to do specifically for buying a new car? And she knows a little bit about what we do because she said, do auto dealers shop you?
Okay. 2 things here to protect yourself from. First of all, auto dealers will shop you. So we go to our clients and we make them fundable for an automobile. And there's ways we can make you look spectacular for a new installment loan, secured installment loan, which is what an auto loan is. We're going to send you to one of your current lenders and get a pre-approval letter for the make and auto of the, and you can get approved for 2 or 3 different types of automobiles if you've done your research, right? And then you go get approved and you've already got your interest rate, you've already got your approval because they know what your score, they've pulled your auto scores and your dial. When you don't know what you're doing and when you are an unsophisticated borrower, you go to the auto dealer and you say, pull my credit and then see who will finance me. And we've seen as few of 3, I've never seen less than 3, we've seen as many as 14 lenders pull credit on the same individual. Now, I know what you're coming back at me with, and I'm just find something to land on because I'm going to pull the rug out underneath this one. Congress came out and said if you, for high-ticket items, usually mortgages and automobiles, but it could be Winnebagos or other types of things, high-ticket items in a 30-day period, they will count all of them. Whether you're shopping for an automobile, over the course of 30 days, they will count all of those inquiries as one inquiry against your score, right? And everybody thinks, awesome! So I can just hit I can hit my credit profile because it only counts once. Okay. It counts once against your score. It counts 14 times against underwriting because you're an unsophisticated borrower who's chasing money. And those don't go away for 24 months. Guys, it counts against underwriting for 24 months. It only counts against your score for 12. So, remember, if they're telling you a story, just know, give us a call, info@CreditSense. Email us. We will. If they're giving you a story, know there's 2 to 3 times more information that you need to know than what they are telling you. Because getting shopped is clearly, mortgages are the same way. Getting shopped is one of the worst things you can possibly do. Now, there's an ancillary thing to this. If you're going to get shopped, there's what's called the spread. All right? And auto dealers are notorious for this. Okay?
Right, so grab a soda, grab a cup of coffee, because we're about to dive deep into the weeds.
Yeah, this is vital that you know. That's why we're here, so I can attempt at a clear drawing. All right. So now we are going to post on here our content manager. Samantha, will you make sure that we post this video on the actual CreditSense page so that they can click it and watch it? All right. There's what I call the credit score pyramid. Look at that. That's legible. All right. So let's call this 850. All right. Let's call this 850. Now we're going to call this 350 because that's generally their scores that go to 250 to 900. But let's just call this. Actually, it's 300. I'm confusing our scores. So this is what's called the range between scores. This is the height of your score, right? We want the highest possible scores, but the reason why it's a pyramid is because sometimes you can have 20, 30, 50 points difference between your highest and your lowest score. No bueno.
So, if I could just, real quick, the range between the highest and lowest score, he's talking about the range that is reported through the software that's scoring you from the bureaus. So you can have a TransUnion that is, let's say if the TransUnion is a 680, your Equifax is a 720, and your Experian is a 630. The range from the lowest to the highest, 720, that's your range.
And so this would be 90-point range. Auto dealers call it the spread. We call it the range because it's a range of scores. But I'm going to show you how they make a crap load of money off of you and you don't even know it. All right? Now, here's the factor. We just had this instance come up from one of our clients. Okay? He goes and buys a Jeep. Now he goes and shops it like a dumbass. He goes and shops it to 5 lenders. So the Jeep Chrysler, yes. The Jeep is a Chrysler company. And so he doesn't know what he's doing. He goes and gets it shopped to 5 different lenders. Now, his highest score, the 3 major scores, are 680 to 670 range. But he had one of his scores that was 630. Okay? This just makes me so mad, and I want you to be prepared for it if you're going shopping soon for a vehicle. Don't let them shop you. Because what he did what he found out is that, so he's thinking, all right, my auto scores are in here, but there's auto score has under Experian, has an auto score 3 that's not a 542. Ask us about it later. But it was 630. So they said, oh yeah, they came back and said, the only approval we got was from a dealer, was from a lender at 630. You are tier 5 approval. Okay? Then, as we suss this out, because we've helped him out to figure this out, but then he gets but the actual outfit that sent him the letters and all those things was Chrysler Corp. And Chrysler Corp, his score was 670. When we looked at, because most people, you guys don't know what to even look for. So he looks for the inquiry that comes, that isn't the Experian, which 630.
Yeah, which FICO 3 is only an Experian version of FICO.
And typically lower than the others.
Yep.
So Chrysler
huge red flag.
Yeah, huge red flag. Chrysler Corporation is Equifax. His Equifax was 670, 3 tiers higher. It wasn't tier 1. 720 is tier 1 for auto. So he was going to have less than perfect paper, right? But they quoted him this, but because Chrysler happens to carry the Jeep paper, they have kickbacks that come back to the dealer, and so they charge this amount, which was a $600 payment, when this payment, we're coming to find out as we suss this out, is a $555 or $556 payment, $45 less per month because of this score and this score, but Chrysler's the one carrying his loan. He makes his payment to Chrysler, not to the lender that was actually quoted him. Living on the spread. They tell you, because when you shop it, you don't know what you got approved for. When you go to a credit union or community bank, you're a tier 1, tier 2 bank, where you do your banking, you get approved, you know what you got approved for. Here, only they know what you actually got approved for, but since we know the game, we're helping him find out that this lender is not who he's making his payments to. They're making it to Chrysler. The inquiry was from, one of the inquiries was Chrysler, and that was a 670. So we're coaching him on how to go back to the dealer and and accuse them of gently first, and then intentional malfeasance later, because he couldn't show the paper trail, their own paper trail, about how he should have around a $555 payment instead of a $600 payment. And that's just bad juju. That's them living on the spread, and that, I guarantee you, everybody fears going car shopping anyway, because it's bad.
Hate it. You gotta deal with the salesman. You gotta do the entire process. Hate it.
Right? But on the back end, if you don't know the game, you're just going to get screwed even further. So that's living on the spread.
And so just to clarify the spread, the spread is the 600. This $600 payment to this $455. That $45 was the spread.
And that's going to the dealer in a kickback.
Yeah, a portion of that's going to the dealer every single month. So imagine how many cars are bought. Why are dealerships so rich? When you look at them, they've got car lots full of cars, but they're making bank. Well, this is one of the ways. And so what we do, and the importance of the range becomes optimizing your profile so your range isn't a 630 up to a 720. So your range is now, in this case, 680 to 700. That's the range of your scores. Those are very near approvals. So when you go in, you're not going to see a $55 difference. What you're going to see is a $5 to $10 difference, if at all, if any.
Because it's the same tier. Because so our objective is, and remember, what we say all the time is we're not score sensitive, we're profile sensitive. So if we develop a profile where we have our target for you is to make a 5 to 10 point spread max. So that no matter where you go, no matter what bureau they pull, you're going to get the same price, same quote. Nobody can run this game on you, even if for some reason you didn't remember to go get a pre-approval at a credit union or your local bank. If you do this, they can't play that game with you because every single score is the same. You don't have that 630 hanging out there that they can use against you.
Yeah. And another way to combat this, if you know what you have, this January we bought my daughter her first car. She was headed to college and needed a reliable vehicle, and so as I hate buying cars. I don't like it as a process. So we found a car online. Like, it was a pretty cool process. We went and got it, drove it back home. But when I was talking to the dealership, I said, I need to know if you guys can pull, and in my case it was Experian. Why? Well, because I knew Experian on every possible score was my highest score. And so I just told them straight up, do you have anybody that can pull only Experian, because I do not want the other two bureaus pulled? They said sure. They pulled a couple, but we walked away with a really, really low interest rate.
Notice, knowing what the rules of the game are going to do versus not. Our client who's still trying to get his legs under him, he's able to still have the dealer's help if it's required. We're not saying don't ever do it. If you need to do it, just be prepared to know.
Yeah.
Go in with your highest score, like Brad did with his daughter.
Yeah, we went in, we got a really low interest rate with her as a co-signer. Now, and here's the interesting thing. Obviously, it proved on my own I had a little better rate, but we're building her credit.
Right.
We're doing exactly what Merrill talked about a minute ago, which was putting her on as a co-signer on an installment loan that she's going to have for at least 2 to 5 years.
Credit sense improved.
Building up her profile and creating a fundable life from there. So that's the idea behind shopping for a car. Don't let them, you shop. Don't let them shop you.
Yeah.
Because they don't need to make $45 a month off of you. That's
just for knowing what you need to know.
Yep.
Right? So,
absolutely.
Yeah, that's awesome.
That is it for my questions.
Yeah.
You good?
Great. I'm good.
All right. Well, hey, thanks everybody. When you watch this, again, info@creditsense.com. You can give us a call if you want, 801-438-9090, and we're happy to answer questions, give you guys some insights, and help you become more fundable. And like we said, we're going to keep changing the buying and the lender environment one borrower at a time. So
perfect,
look forward to seeing you next time.
See you next week.
Hey guys, thank you for listening to Are You Effable? Please leave comments because I would love to read about your aha moments from this episode. And be sure to visit fundinghackers.com to view the blog post, get important links, join our community, and much, much more. And you gotta tell your friends about this podcast. We want them to become effable too.